Get ready to take a flamethrower to the official narrative and learn what the elites don't want you to know. You're listening to The Tom Woods Show.
Hi everybody, Tom Woods here. It's episode 2647 of The Tom Woods Show. And we're joined today, once again, by Luke Tatum, who is founder of Perfect Spiral Capital and author of Between the Lies, How to Reclaim Your Future from the Banks and Wall Street. Luke, welcome back.
Thank you so much, Tom. It's a pleasure to be back.
All right. Everybody gets all kinds of guidance on the economy, and some people say this, and some people say that, and some people say everything is overheating, and other people say, no, that just means there are opportunities everywhere. People say you should get in, people say you should get out. And I think after a while, people just start tuning it out because they think there is some economist somewhere advocating the pro and the con, advocating the yes and the no, the good and the bad side of things. And they just throw up their hands and say, I don't know what I'm supposed to think. So let's start there. How can you break through that and reach people and say, I know there are a lot of people telling you this, that, and the other thing, but there really is a truth of the matter. There really, honest to goodness, is a truth of the matter. There is a correct and incorrect way of looking at where we are, areas you should be cautious about, the types of financial planning you ought to be doing for your future. There really are correct answers to this.
Right. And you're absolutely right. I mean, not only are there economists on both sides that'll tell you any story that you choose to hear, but they're also fighting about it publicly on Twitter. And so you can participate in that and root for your guy. And I mean, it's a kind of impossible to see through that noise sometimes. And so, we kind of follow a very rigid process guiding our clients through things. But a lot of what I like to look at is not, what's the stock market doing today? Oh, the Dow is up. Oh, the NASDAQ is up, or we're down for 2 or 3 months at a time. Oh, the president must be at fault. There's just, You can see every explanation for every situation every day, and people will flip-flop from one explanation to the other. And it's just a mess. And so we do not like to participate, in my office and my team. We don't like to participate in that kind of just what I'll call fear-mongering. We like to look at fundamentals, and we go all the way back from, okay, what is this corporation doing? What is this, private equity firm doing? We go way back to the very, very fundamentals. Where is the money? Well, the money was with insurance companies and banks. Of course, banks are making new money whenever they're making loans. But it's very, very base level whenever you're working with, someone like me. We're just going to kind of ignore a lot of what's going on in the stock market because it doesn't have an impact on what we're doing, day to day, if that answers the question.
Well, tell me about the kind of thing you do day to day.
Yeah, sure. So we're infinite banking concept practitioners, right? There's episodes on your show in the past, my previous episode, talking about what the infinite banking concept is. Fundamentally, we're talking about a process, and it's an understanding about money. So to your point about truth, we're just telling you how things are. And when you kind of understand the mechanics that really underpin everything, it's somewhat obvious what you should do with that information, once you get it. But it's very hard to unlearn a lot of that. So really what we're doing on a day-to-day basis is teaching people. We are a financial education company before we're anything else. So we have courses that we produce, we have YouTube videos, all those things. But we're just trying to give people that foundation and that clarity. If you've ever read, some of the very, very basic financial books out there, Think and Grow Rich and things like that, we're at that level. It's, okay, I've read this book. I feel like I kind of know what I need to do next, but I don't really know what I need to do next. You kind of need someone to kind of guide you through that process. And so that's where we come in. We teach a lot from Becoming Your Own Banker by R. Nelson Nash. And we require people to have a copy of that book if we work with them, because it's a 92-page book. Just grab it. Let's talk about it. And that has nothing to do with stock market fluctuations, has nothing to do with, what these mega corporations are doing in 11 countries to, make their books look a little better this quarter, make their investors happy. It doesn't matter to me. I know a little about what's going on with some of those things, and maybe there's some things to worry about in that space. But that's not something that I'm, stressing out about with clients.
I'm opening a big can of worms here, but when I think about insurance companies, I think of companies that have been around a long time that have figured out a way to take what are usually fairly modest insurance premiums and somehow manage that money so that when people, a certain percentage of people are going to die before they get to a certain age, but actually, no, I guess the way I want to say that is they're able to somehow make what seems to be an impossible promise, like particularly in life insurance, seems like an impossible promise that if such and such person dies, they will pay out X amount of dollars, and X can be a pretty big amount of money.
Right.
So I've always wondered, well, what kind of investment strategies are they pursuing? Because whatever they're pursuing, maybe I should do. If they're able to make good on $1 million policy that costs a few $100s a year, I want to know what they're doing with their money. Now, but at the same time, I also I can't help but have this sense that as the U.S. economy, in some periods of time in the past 20 years, as it has gone up and down, I've wondered, how are the insurance companies going to weather this? Or how are they going to weather the COVID period, where all of a sudden, there were numbers of deaths attributed to COVID or not attributed to COVID, but there were, in certain parts of the country, an elevated number of deaths.
Mm-hmm.
How could they have planned for this? How could they have planned for something like 9/11? I wonder, have they become rickety? I don't know anything about the internal operation of these firms. Where do you think that all is?
Yeah, I mean, a lot of these companies, so, Perfect Spiral Capital, we work with mutually owned insurance companies. And so if you own a product with one of those mutually owned companies, you actually will get a financial statement from them. They'll tell you what they're invested in. They're not going to list out every single thing that they own, but they're going to give you, a GAAP balance sheet, and they're going to show you kind of what their books look like because they're proud of them. And a lot of these companies have paid dividends, 100 plus years, 115 plus years in a row to their policyholders. And so that's an excellent question, right? How do you do that when you have something like 9/11 or COVID or some of these situations? How do you go, well, yeah, we still made enough money to pay a dividend? I mean, that might make you think there's something nefarious going on there, but it's not. It's really a very, very simple thing. They charge more than they need to, right? It's a little bit of room on top all the time that they're going to take in based on generally accepted mortality numbers. So how many people are going to pass away that are age 41 this year? Well, we don't know who is going to pass away, but the insurance companies, the mortality information, they know pretty much how many. And so if they have a group of 41-year-old males that are of similar health, they can say, okay, cool. There's 1,000 of these people. They're in a kind of a block. And if one of them passes away, we've got enough, right? When you're looking at very, very young parts of the population, talking, under 18, things like that, the statistical likelihood is basically zero that anyone in that group is going to pass away. And so it gets very difficult to price that kind of product at that point. But as you get older, of course, the mortality risk gets very high. And over a long enough timeline, you're dealing with something like whole life, which insures you all the way to age 121. I don't know how you feel about that, but I think I'm probably not going to make it to 121, But it's built that way so that even if you survive all the way to 121, well, they're going to give you the whole check while you're still alive. And that's just the nature of it. It's like fire insurance, the classic example. You've got 1,000 houses in a similar area with a similar risk of burning down. Well, what do you charge to do that? But your question too was about investment. What are they invested in? And so it's the most boring stuff in the world. It's a lot of corporate bonds, AAA rated, seasoned corporate bonds. They'll have a little bit, maybe 5% in stocks, equities. But they're going to have a whole lot of money in seasoned corporate debt. And we're talking reliable corporate debt. They're not buying, some startup company's debt. They're buying, Coca-Cola Corporation debt to manage that. And it's very predictable. It's very stable. And that's how they're able to do it, right? They are able to lock in really large amounts of time, really long dated bonds. And they just know, okay, well, we've got this portfolio of this much money and it's going to yield us this much in interest. And they've got a 30-year bond or a 20-year bond. Well, okay, we know what we're going to make over the next 20 years, 30 years with this portion. And then they're always having to refresh that portfolio, but it's a very, very stable business. They're the best bond brokers in the world that work for these insurance companies.
But isn't one of the points that you've been making that there's something that's been going on in with some of these life insurance companies in recent times in which they have become not quite so conservative?
Yes, yeah, and so I'm glad you're asking, because there's a lot to say for what type of insurance company you're dealing with. And this is maybe my, fire alarm, trying to get the word out there in the industry, because nobody thinks about their life insurance policy. You talk to somebody, you sign up for a policy, you forget about it for 30 years. That's how it goes. The person stops working in the industry, you don't even think about it. And you go, oh yeah, I still have that. I wonder if it's even valid, And that's how the insurance world works. But yes, the nature of the company itself. So like I mentioned, we work with mutually owned insurance companies. If I buy a product from one of these companies, I own the company. I don't own all of it, but I own a little bit, and that's where the dividend comes in and all those things. But the majority of insurance companies are stock companies. And so they are either publicly traded on the S&P 500 or what have you, or they're private, but they're stock companies. There is stock that can be purchased, and you could become a majority owner of one of these companies. And that is a problem. It's been fine for decades, but in recent years, especially as some financial regulations have changed in the last, say, 20 years, there are a lot of private equity groups which are off the books, not public companies, not Coca-Cola Corporation, right? Private, what they call dark pools of money. There are private companies that have come together, and they are putting together these very, very, very debt-heavy deals. We're talking hundreds of billions of dollars in some cases, where they are pooling all this money together and either hostile takeover, buying all the shares of a company, or they're setting up a reinsurance company to take advantage of something. A lot of detail we can get into, on those specific trains of thought. But what they're doing is they're taking over a very conservative company. And like we talked about, they should be conservative. They need to have very boring investments, because the whole point of insurance is to manage money for an extremely long duration, to be there whenever something happens, to pay that, death benefit check, or to pay that income for someone with an annuity. That's what it's for. That's what they're supposed to do. And there's even regulations limiting how risky they can get with their portfolios. But these private equity firms are acquiring companies, names that Allstate was acquired. The Allstate life and annuity business was acquired just a few years ago. And what they're doing is gutting the company, laying off tons of people, selling off assets, changing the asset mix. They're pushing them into much, much, much more aggressive investment positions And so if you have a policy with whatever company it is, you might want to know that. It's getting less and less likely that they're going to be able to pay and make good on all these promises that they've made over the last 50, 60, 70, 100 years to all their policyholders. That's the kind of thing that keeps me up at night. But I know there's like 11 people on the internet talking about it. So, that's what I wanted to get out there.
If you're worried about the value of your hard-earned savings getting eaten away by inflation, trade wars, or reckless Fed policy, it's time to secure and grow your wealth in something they can't inflate away, and that's gold. But a lot of gold owners just buy gold and then let it sit there collecting dust, and then feel like they're missing out on the growth happening in other asset classes. Well, that's why I lease my gold with Monetary Metals. I earn a 4% annual yield paid in gold every single month while still owning my ounces. Again, the yield you earn is paid in ounces of physical gold, which you get in addition to any price appreciation from gold during the year, which, as you know, continues to break all-time highs in 2025. Join me and thousands of happy clients who are earning a gold income every single month. This is a no-brainer for those looking to earn an honest return in honest money. The Fed can print dollars, they can't print gold. Now's the time for you to start growing your wealth in ounces. Go to monetary-metals.com/woods to learn more. That's monetary-metals.com/woods. Now that we know that, how should we behave differently? Like what course of action is called for in this situation?
Well, the first thing I would say is to just do a little looking. Whatever you have in place, if you're in a decent financial position, you've got some life insurance, you're maybe even have some annuities, you're thinking about retirement, and annuity is part of your retirement strategy, for example, then you need to look at that company and see who owns it. Has the leadership changed recently? Has the leadership changed 2 or 3 times recently? Because what a private equity firm is going to do is they're trying to flip this company. They're going to make it look as good as they possibly can on the books in a short period of time. And a lot of money is going to move around. They're going to pay themselves a lot in dividends, and then they're going to sell the company while it still looks good before the impact of a lot of these things happen. There have been some very successful private equity deals. I'm not telling you, I'm not trying to be an alarmist on this. I'm not telling you every life insurance company is about to go out of business. Okay. But some of them are over the next 5 to 10 years. And that may interfere with the planning that you've done, your estate planning, especially if you're high net worth and you're trying to evade some, estate taxes and those sorts of things. You probably need to look into that. So step 1 would be become aware with what's going on with your company. It's hard to keep up. There's 300, 400 of these deals a year nowadays. And then step 2 would be consider adjusting that planning that you've done. So if you're not with a mutually owned company, like I say, you can't really buy out a mutually owned company like that. You can't become the majority owner. So maybe consider, there's only a handful of mutual companies out there. Maybe consider looking at those and revisiting some of that planning, updating your estate documents, those sorts of things.
No, I don't know anything about this other than I have life insurance and I'm happy with it.
And 99% of people don't know anything about it.
Yeah, and no doubt. But I mean, I pay the annual premium. It's a very reputable company that I'm using, and I don't even think about it. So you're right. I don't even think about it. I pay the premium. I don't even think about it. I would not want something to happen whereby the company couldn't deliver. Obviously, I don't want that. So I have like most people who have life insurance, a vested interest in this question. Right. Now, apparently, I say so. I don't know anything about this product, this stuff called Universal Life. I don't know what that is. Okay. But apparently, it's a big deal these days, and there might be some risks associated with it.
Yeah, this is, gosh, and thank you for asking. It's one of the most misunderstood things because if you just go on YouTube or especially TikTok and you watch a 1.5 minute video or a 40-second video about this, you're going to think it's the greatest thing that's ever been invented, period, full stop. And, it's amazing. It allows you to do everything that every product has ever allowed. And it's unbelievable how hyped up universal life can be. Now, I don't want to get, so far into the weeds talking about all the different types, but there's permutations and variations. Universal life, variable universal life, indexed universal life is the big one that companies just cannot wait to sell to you. And this is a product that has some problems. First of all, universal life, the company that invented it, as an insurance agent, I can't call out insurance companies and talk badly about them, but you can look it up. The company that came up with universal life in the first place, there's a whole bunch of scandals. They went out of business. It's not a good thing. But people couldn't get enough of it. And it's a very recent innovation. It's from the 80s. But universal life is term insurance. You familiar with term, Tom? 10-year term, 15-year term. So you've got term for a limited window, and then after that time, you don't. That's as simple as it could be. Well, universal life is 1-year term that renews every year. And so when you're 30, it's pretty cheap. When you're 55, it's not as cheap anymore. When you're 70, it's really just not cheap at all. It's extremely expensive to sign up for insurance over and over again. You don't get underwritten every year. You don't have to get blood work every year. But the price is going up based on your age. So the theory of universal life is, well, it's really cheap. So go ahead and sign up now and pay more than you need to. And they're going to deduct out the cost of the insurance every year. But because you're putting in so much money and our portfolio is going to do so great, you're going to make more money than you're going to lose as you renew that term every year. That's kind of what's going on there. And so index universal life or variable universal life, these stock market versions of that are saying, well, if we can just make you so much money all the time, then your policy will never have to cancel. You'll never have any bad things happen. But that's the fundamental problem with universal life is if you live a long time, it's going to get so expensive that it's going to eat up the cash value. So permanent insurance has a cash value. And it's going to pull right out of that each year as you get older, right? So if you're 75, 80, 85, it's going to get to a point where it will collapse on itself. And so then when you need insurance, you don't have it. It will cancel. Or what they'll do is call you and say, well, I know you were paying $500 a month, but you're going to need to pay probably $2,500 a month or we're going to have to cancel it. Right, that's the conversation they're going to throw at you after you've paid $300,000 over your entire life, this policy. I'm working with a gentleman right now, actually, who has 2 large universal life policies, and he has paid in a lot of money over a very long period of time, and they're about to cancel on him. So we're trying to scramble and figure out what to do about that. And thankfully, I think that we've got a solution. But that is a situation you don't want to be in. The idea of set it and forget it is what it should be. That's what you should be able to do with your life insurance. To me, you as the policyholder, you as the insured are keeping all the risk. The whole point of insurance is to give the risk to the insurance company. I get car insurance so I don't have to pay if I get into a crazy car accident, right? If I get life insurance, but they're going to cancel it on me just because I got older and I actually have a risk of death, that doesn't make any sense, kind of on a fundamental level to me. So dress it up in whatever way you like, put whatever stock market gains on top that you want, but that's the fundamental issue that's going to emerge over a long enough timeline.
All right. So now I have to go do some research about my. I think I'm probably okay, but
sorry to cause you some extra work there.
See, it seems like sometimes I feel like the Tom Woods Show is about alarming you about things you had no idea you need to be alarmed about. That's pretty much the theme of the Tom Woods Show. So,
And I don't like to cause fear, and I don't
no,
like
you
to
want
do
to
that
give
to people,
solutions to people,
right,
I presume.
I do.
So maybe at the end we'll talk about what exactly it is that you do. But you
Sure.
seem to have like a quite a bit of background in life insurance and stuff. And I mean, were you tracking this like during COVID? How they were? Presumably they're tracking COVID as a separate cause of death, but apparently now they're not doing that anymore.
Yeah. That's so. I go to this conference every year, and we get to hear from people, C-suite executives at major insurance companies, and we're not allowed to record it. So, I have my notes that I wrote by hand, but we can't put them on the spot and, really capture all the little comments and all the stuff from it. But that is something that I learned this year, is that COVID is no longer tracked as a separate cause of death. There was a lot of concern 2020, 2021 that, there's excess mortality. There's so many additional deaths happening. There's it's crushing life insurance companies. They're all going to go out of business. And so stuff that we do, which is permanent insurance, was under fire in a sense during that time. Now, there were some companies that went out of business. And you know what? Those companies, they focused on term life and selling you like a Roth IRA on the side, those kind of things. Or they were very all in on the IULs, those kind of things. It's a different portfolio, and it can cause some risks for the insurance company itself. But the ones that were focusing on the whole life policies, the more permanent traditional products, they didn't have any problem whatsoever. They were still paying a dividend, right? But we learned that the COVID deaths were tracked separately. They were told to track them separately, and there was a whole lot of hubbub about that. But they eventually just had the data and saw that it was no longer an issue. They said, well, there's no point in tracking this. It's not a significant factor. No one is dying from COVID. I don't have the ability to tell you exactly when that happened. No. So I don't know exactly how long they tracked it. But as the data came in, they said, well, we had to start asking people, are you planning to travel outside of the US or Canada within the next year? We had to ask that on life insurance applications. And that was basically a COVID question. So are you going to go somewhere else and bring COVID back with you, and those kind of things. But we still have to ask that question, but then no longer care about the COVID stuff. So it's just kind of an interesting little anomaly in the data set now that no one cares about.
Well, I don't want to get you, in trouble on this whole matter, but what I was thinking about with the insurance companies was actually less COVID itself than the issue of the excess deaths that occurred after the introduction of the what.
Right.
And
right.
Who would have planned for that?
Right.
So,
I wonder. They don't track that, to my knowledge, they don't track that as a separate thing. But that's the thing about insurance companies, Tom. They're very, very data driven. If you want the real picture of what's going on, with mortality, with bond markets, those kind of things, they know. That's all they do is manage long-term debt and obligations. And so whether or not they'll tell you is a different question, but they know.
All right. So this is a world that's slightly more complicated than we thought in that, the fact is insurance companies have a extraordinarily good reputation for stability, conservatism in the best sense of the word. But now you're suggesting that, unfortunately, some practices have started to creep in that could bite people in the where, and that could have consequences that we're not prepared for and are not aware of. And if that's the case, and I have no reason not to believe you, I've known you a while, what do you want the ordinary person to do, basically? Other than, I don't really want to have to study all the life insurance companies' portfolios, and I wouldn't know how to evaluate it. I wouldn't know what to look for. I don't want to do that. So what do I do?
Right. And I don't really particularly want to do that anyway myself. It's just that's the sort of place that I've landed. Growing up, I thought there's no way in the world I'm ever going to care about all this finance stuff. And then, here I am. But the thing is really going back and unwinding all of this stuff, all of the stuff that you've been told about money your whole life. A lot of that is well-intentioned, but it's really not serving you very well. What we're basically told is, well, there's inflation. And, well, you got to beat inflation. And so you need to make a lot of money and you need to put some of that money aside, and they'll call it saving for retirement. Well, it's investing. It's investing for retirement. It's give all your money to Wall Street fund managers and they're going to take care of you. Don't worry about a thing. You're going to have this huge nest egg and you're going to be able to retire and it's going to be great. And that really just isn't the case for a lot of people. I've talked to hundreds and hundreds of people about their financial situation, and it's just not what I see. It's not what has happened. And so what do you do about all this? What do you do to position yourself away from the ups and the downs of the market? What if you were trying to retire in 2008? What would you do? Well, you end up working at Walmart or something, right? Because you need to have something to do for a period of time while you wait for your portfolio to recover, right? That's the situation that a lot of people found themselves in. And so what do you do? What do you do? Well, I wrote my book, and of course we've talked about it before, Between the Lies. You can find that at betweenthelliesbook.com. And it's a toolkit in a way. It's a workbook in a way. It's a longish book, but it's got a step-by-step kind of plan that I lay out in there for what to do. And we're coaching people to not learn how to read accounting sheets, and balance sheets for businesses and those kind of things, because you don't need that information. We're teaching the minimum amount that you need to know, but there is some learning involved so that you can say, okay, my wealth is safely set aside in a place that is safer than a bank. And that's going to be a life insurance policy. That's what we're teaching. It's a whole life insurance policy. It's not index universal life. It's not any of these other, modern permutations that have gotten companies into some trouble. And there's multiple active lawsuits right now against insurance companies for understating their mortality expenses and overstating their investment performance and all these sorts of things within those products. And again, I won't name names, but there are things not to do. And so don't do them. So we walk through those sorts of things, look at someone's current financial situation and, see where they're at, meet them where they are, work through that initial education on infinite banking. How does life insurance actually work? Why do you want your money to be in insurance rather than in a bank account? It's because it's safer than a bank account and it's going to perform better for you than a bank account. And then how do you deploy that capital that you're saving, not investing, but saving in life insurance, and build a portfolio of income generating assets? It's a specific order that we're going to walk people through doing those things. You don't go chase the high rates of return. You don't go build a portfolio of income producing assets while you've got a mountain of debt and while you're shoveling a bunch of money into things that they don't need to be shoveled into. But it's a process. And so everyone's process takes a different amount of time. But we've got the book and we've got a toolkit for your audience, Tom. So we've got perfectspiralcapital.com/woods. We'll give a whole lot of free resources, including a digital copy of the book, a course that I did, a whole bunch of things. And that's all just available to anyone that's watching this episode, listening to this episode. But for me and for my team, and after having all these conversations, month in, month out, it has to start with education, because a lot of people believe a lot of things about money that just aren't true. And that is a problem. You can't make the right decisions without having the right framework. And so people challenge me all the time. I can't hardly make a social media post without somebody wanting to fight about it. But, I'm happy to stand by what is true because it's easy. It's easy to verify. So I realize I'm rambling at this point, but does
Well, look, let me just say this. If somebody had taken, I don't know, $100,000 and put it into some kind of an index fund, with the S&P 500 over the past few years, they would come out with probably 50% ahead a few years later. And so I understand people's skepticism about the stock market. Believe me, I know, I understand completely where that's coming from.
Right.
But at the same time, I feel like so many good people have missed out on an absolute fortune because they've been so bearish about it and they've avoided it so much. So what do you say to that?
Yeah, I mean, it's a great question. And the thing I'll tell you is I love the stock market. I don't have anything to say about that. Like, I'm not saying you're wrong, right? Because yes, there are returns to be made in the stock market. There's returns to be made in trading options. There's returns to be made in real estate investing. You could buy a real estate investment trust and get some pretty healthy returns if you buy the right one. There's lots and lots and lots of ways to make money. But when I say we're kind of going to fundamentals first and we follow kind of a process, we stick to an order, it's because how much money would you put in the stock market, right? Well, if you're a regular average working American, you might be able to squeeze 5, 6, 7% of your paycheck into the stock market, your dollar cost averaging. You're putting it into a retirement account, something like that. That's how people are generally participating in the market. And so they're investing when it's up, they're investing when it's down. They're averaging out their highs and their lows, right? That's what they're doing. They're getting kind of a normal average amount of return on their money. And meanwhile, at the exact same time, they're financing a house, they're financing 2 cars, they're paying astronomical amounts of money for all sorts of different things. And in a lot of cases, the numbers fluctuate from year to year, but that's about 35% of a lot of people's after-tax income going to debt service. And so that is very, very early in our process. What's your debt situation look like? How can we get that knocked out? Would you rather be able to put 30% of your money into a good investment on a regular basis because it's not going to debt servicing? That for me, yes, that's what I would like to do. And paying off our first house, the only, mortgage that we had when we were in Texas and stuff, we loved that. We framed our paid and canceled letter, and man, our life got so much better after that. So debt elimination is a big part of what we do. People will tell you don't pay off your mortgage. I disagree with that. And it's a conversation to have. But it's freeing up that master-slave relationship, if you will, between the banks and you, where you're just working to pay them. That has to come early in the process, in my view.
All right, but let's split. Now, I get tremendous psychological satisfaction from not having any debt.
Yeah.
So yes, I have paid off my mortgage.
Yeah, perfect.
But in a way, I kind of wish I hadn't.
Okay.
And I think you know what I'm going to say. If I could now, obviously, I could take out a home equity line of credit if I want to, but then I have to pay interest on that.
Right.
Whereas if I had just had money that I hadn't put it toward the house and just paid a small interest every month, I could be putting that in things that generate such higher returns than the pitiful interest I was paying on the mortgage that I would be silly to lock that money up in the house when I could be putting it toward income-producing assets. What's wrong with that? Is it that there's too much risk involved?
Well, I mean, when you talk about, say, stock market collapse, real estate market collapse, things like that, there are certainly risks associated with those things. You could, have wild fluctuation in the area that you live and real estate prices. There's things like that. I have someone who is priced out of being able to keep their mortgage because property taxes went up so much, because of the value of their house going up so much, and it's rolled into their mortgage. They couldn't do anything about it. They had to keep making that payment. And so, I mean, it depends on the situation. This is not financial advice. We're just having a conversation because I can't give financial advice without knowing a whole lot of information about a particular situation. So, no, it's not wrong, to go back and say that. But that's the way that we work through those things is just to say, okay, let's free up the maximum amount of cash flow first. And some people are going to be just like you and say, well, my mortgage is 2%. I think I'll just keep it because it's a huge amount of money. They got tons. They've already got 15 years in. They're paying half and half principal and interest instead of paying 78% interest at the beginning of the mortgage, those kind of things. So they're all considerations. And I don't tell people they're wrong for wanting to do that. But personally, I love just the complete freedom of being able to do whatever we want. We were able to leverage this property to acquire another property because it was paid off. So we had some interesting opportunities that were just not on the table otherwise. Our net worth position looked very, very good. And so we were able to get some things done. But, when it comes to the mortgage, that's kind of, some people will say they're debt free and they still have a mortgage, right?
Yeah.
So it's just kind of it's how you were raised, how you kind of think about those things. But certainly other types of debt, we would focus on that first. And then what I would say is if you need to finance something, then you want to use your own capital. You want to, what Nelson Nash would say, becoming your own banker. You want to become your own banker. You want to self-finance these different things. So you have all the control over how you're spreading those costs out over time. And that includes investing. So if I need to make a large investment purchase, well, I have lots and lots of money in life insurance, and that's where the money is going to come from. I'm going to shift my assets into a good opportunity and capitalize on, hey, the market's down 40%. Let me load up on some stocks. The big problem people have doing stock market investing oftentimes is that they don't have any money whenever the stocks are on sale, right? They aren't taking advantage of the big opportunities. They aren't able to buy that amazing lot 3 blocks down the road that they could fix up and flip because they just don't have any money. They're not capitalized. They're paying debt payments to other people. And so, yes, you could use a HELOC. Yes, you could use a line of credit. But then you're reintroducing risk. You're subject to the interest rates of the time. You don't get to pick how that's going to look for you, right? If you're running a life insurance policy as your financial foundation, you're in a lot of control over how that's going to look and how you're going to spread that out over time. I'm trying not to get real into the weeds, Tom. So, forgive me if I'm not getting quite far enough in. Tell me where you'd like to, go from there.
Well, no, look, it depends on your risk tolerance.
Yeah, it definitely does.
And it depends on your financial knowledge, because maybe if people had, there was a time in my life that if I had $500,000, I wouldn't know what to do with it anyway.
Exactly.
So I might as well pay off the mortgage with it.
Right.
So, all right. So tell people again exactly what I'd love that you set up something with /Woods. It shows you're a Tom Woods Show listener. If you come on the Tom Woods Show, you don't have something with /Woods. It is a missed opportunity. Tell us that again.
Yeah, absolutely. So perfectspiralcapital.com/Woods. It is a toolkit to break into what we're doing, the infinite banking concept, kind of see our whole process, what we call the truth blueprint. So we've got a workbook that'll guide you through that truth blueprint, explain what every step is, what that's all about. It's got a free copy of my book, a PDF format. And so that's a good 200 pages worth of reading there. Got a couple of free courses available. If you decide to work with us at some point in the future, we've got lots of exclusive client tools and things like that built in. So there's a whole lot of value there, hours and hours of material that you can kind of choose what interests you and get into and learn more about the specifics. You might have heard, if you're a long-term Tom Woods listener like myself, you might have heard of the infinite banking concept. You might have heard Bob Murphy talk about that, in previous episodes. But you might not really know much more other than the name And so if that's you, there's a lot of great resources in there to kind of get your feet wet.
All right. I'll make sure that link is up on the show notes page, tomwoods.com/2647, also in the video description. I'll also link to your book, incidentally, because people may also have interest in reading that. Luke, I appreciate your time, and I know that anybody who talks to you and gets a consult with you will be in very good hands. So thank you very much.
Thanks, Tom, so much.
And thank you, ladies and gentlemen.
Make yourself and those you love less vulnerable to the regime, both mentally and physically. Get more forbidden information at tomsfreebooks.com and be sure to subscribe to the show wherever you listen. See you next time.
Like the sound of The Tom Woods Show? My audio production is provided by Podsworth Media. Check them out at podsworth.com.